So in this video, we're going to be talking about the income statement and just providing a brief kind of introduction to the income statement and talking about a few items that are going to be important as we move forward with a more detailed example and analysis of the income statement moving forward in the course. So first of all, now we're moving on from the balance sheet, and so we're getting into the other three statements within the system. And if you remember from some of the first classes, I talked about how the balance sheet was unique in that it is a snapshot of the business at a given point in time, while the other three statements are measures of things that are occurring over a period of time, specifically over the course of a reporting period, which we might typically think of as 1 year. So the income statement specifically is a summary of the revenues and expenditures of a business, particular entity, over a interval of time. Again, that interval is a reporting period, and we usually think of those as a 1 year period. Income statement is used for a number of things. In terms of analysis, though, its purpose is to measure performance as they relate to profitability. So revenues, expenses, and income. In terms of preparing the income statement, there are kind of two broad accounting approaches that are used. So cash and accrual. Cash accounting will record transactions or include transactions on the income statement whenever the cash flow actually happens, whereas accrual accounting recognizes things when the actual actions occur. In starting out here, it may be kind of difficult to understand the difference between those two. But one example might be just thinking about kind of your daily lives. If you use a credit card to make a purchase, you might buy something and then you don't actually pay your credit card bill until the end of your statement cycle, which might be a month or more down the road. A cash accounting approach would count that purchase as happening when you pay your credit card bill, which is at some point in the future, whereas an accrual system would record that as happening the day that the purchase was actually made. So again, that's just trying to illustrate the difference between what I mean by when the cash flow occurs versus when the actual activity or the action associated with that transaction occurs. Now, the reason why we talk about both cash and accrual in this class is farm firms. Farms are, again, a type of small business that we might think of. And farm firms are still able to use cash accounting for tax purposes. And most farms still elect to do that just because of some of the flexibility that it provides farm business owners in terms of adjusting the timing of expenses and basically being able to impact the tax bill that they might have in any given year. However, most corporations for sure would be preparing things on an accrual basis, and when we think about putting financial statements together for analysis purposes or for lending purposes, if a banker wants to see what our financial statements look like as we apply for a loan, in those cases, it's typically preferred and in some cases required to have accrual type of statements because they want to actually see things as they are occurring rather than when the cash flows may occur. So just keep that in mind moving forward. In terms of layout, what the income statement actually looks like, pretty basic, a pretty standard approach is what most use. Specific lines, entries, labels, categories are going to differ across businesses, but in general, we start out at the top of an income statement with a revenue section. Then below that will be potentially various expense subsections. Our income statements that we work with in this class for examples and homeworks and things you'll see on exams typically are going to include an operating expense section, a separate section for interest, an other or non-business expense section, and then a tax section. And then after expenses, we'll have a net income measure, which is what is left at the bottom of the income statement after all expenses are paid out of the revenues that a business earns. And this is kind of an important concept to understand. I mean, visually, I think it makes sense. But when you think about revenue, there's really only there's really only two broad ways that revenues can be used. They either pay expenses, and in our cases, that might go into 4 different subcategories: operating, interest, taxes, other non-business expenses, or revenue can pay into net income. That's what falls through falls through the income statement. So we start out with a revenue number towards the top, and as we move down, that revenue is being eaten up, taken away by various expense categories. What ends up falling through the bottom is where we see net income come into play on that income statement. Another thing to keep in mind as we keep working through the preparation of the financial statements section towards the analysis portion of the course is thinking about how revenues are allocated across their various uses. So again, revenues can go towards paying expenses, various subcategories we'll look at there, or the remainder falls through as net income on the income statement. So when we start allocating where revenues go on a percentage basis, X percent goes to operating expenses, Y percent goes to pay interest, Z percent goes to taxes, and then the final portion would be what is left over in net income. If you add those percentages up, they have to add to 1. Every revenue dollar is accounted for in some way. Either it goes to pay an expense or it falls through to net income. So as I said before, we'll be looking at considering both cash and accrual accounting methods, but when we prepare our income statements and the examples and homeworks and everything else for the course, we will be using the accrual method. So one of the things we'll have to understand and get comfortable doing is making accrual adjustments on our income statement. These are things that you guys will all grow to love over the next week or so. But basically, accrual adjustments are things that we do within each section of the income statement. So we have adjustments we make in the revenue section. We have different adjustments we make in the expense sections. And what these accrual adjustments reflect is how the balances of accounts or things of value or obligation have changed during the reporting period. So specifically, we take that information from asset and liability accounts from the business's balance sheet. Specifically, beginning and ending balance sheet values are used to make those accrual adjustments throughout our income statement. Accrual adjustments are pretty simple. An adjustment is always the ending minus beginning value for that specific account from the balance sheet. But it gets a bit more complicated in terms of how that adjustment is actually used or what is done with that adjustment on the income statement itself, whether that adjustment is added or subtracted within the revenue or expense section that it shows up in. So we're going to have 2 broad categories of adjustments: revenue adjustments and expense adjustments. And then for expense adjustments, there's actually 2 types. So a total of 3 types of adjustments that we'll be considering here. So revenue adjustments are adjustments that are added to the cash revenue number on our income statement. And then for expenses, we have normal adjustments, which are added to the cash expense value in that category. We also have contra expense adjustments, which are subtracted from cash expenses. Again, this can get confusing. We'll talk more about what revenue adjustments are versus normal versus contra expense adjustments as we continue to work through the income statement and the example. But for now, just know that there will be 3 types of adjustments, and that affects how we treat the adjustment on our income statement. So as a quick, simple example, we're going to look at what a revenue adjustment might be, an account that is associated with a revenue adjustment. In our example here, we're looking at accounts receivable. So again, accounts receivable represent the value of sales that a business has made but not yet collected. So, again, these represent things that an action has occurred, a sale has been made, This is money that is owed to the business, but the cash flow hasn't actually happened yet. So this is money that is due to the business from its customers or clients. As I said, adjustments, regardless of their type, revenue, expense, it doesn't matter, are always calculated as ending value minus beginning value for that account. For our accounts receivable example here, we have an ending balance of $5,000 in receivables and a beginning balance of $2,500 in receivables. So what that means in terms of the accounts receivable accrual adjustment is that we'd have a value of $2,500. That reflects the $5,000 ending balance minus the $2,500 beginning balance. And what we would actually do with this $2,500 adjustment is this would show up in our revenue section and would be added to the cash revenues that the business collected during the year to adjust those to an accrual basis. Again, we'll see this in more detail in the examples in upcoming lectures, but that just gives you a quick example of how a revenue adjustment for a specific account, in this case accounts receivables, is actually calculated. Okay, just a few more final points in this introduction video to the income statement. First, I want to emphasize the fact that, again, we're going to be looking at both cash and accrual accounting systems and how they can result in differences. So an important thing to keep in mind is that just because cash is received, so a cash receipt that the business receives, does not necessarily mean that that is income or revenue for the current period. It may reflect actions that are from previous periods. Similarly, just because a check is written or cash is paid for an expenditure does not mean that that expense actually occurred in the period that the cash flow occurs. So again, cash versus accrual approaches are going to adjust for those things in terms of the timing of cash flows under the cash system versus the timing of actions under the accrual system. Second, we're going to be talking about a number of balance sheet accounts that are used to make accrual adjustments on the income statement. And it's important to keep in mind and understand that the cash balance on the income statement is not an account that we use for accrual adjustments. All right, and it again is something that can be somewhat difficult to understand at first, but I think will become clear as we continue to work through things. But the tracking of changes in cash are reconciled on the cash flow statement, and they do not represent any sort of accrual adjustment that we make on the income statement. Those changes in cash numbers are captured in the cash numbers that we start with on the income statement. Thus, there's no additional accrual adjustment needed or used based on the cash balance, cash account balances on the balance sheet. Third, principal payments. So the portions of our loan payments that are going back to paying down the original amount borrowed do not affect income and are not included on the income statement. So whenever we pay back a loan, a portion of the payment is going towards interest. That is an expense that shows up on the income statement, but principal does not. And again, this can be kind of confusing as to why we don't consider principal repayment an expense. And this is tied to the fact that we expense those items using depreciation, not with the actual cash flows that reflect paying for that asset. And the same thing is true for revenues that might come in, cash inflows that might come in when we take on a new loan. We don't recognize them as revenue on our income statement for tax purposes. Again, as we keep moving forward, hopefully this will become more clear. But the principal portion of payments or new loans taken in do not show up and do not affect anything on the business's income statement. Capital items that are depreciable are not expensed fully in the period that they're purchased. So we talked a little bit about this in the accounting depreciation section that we've covered so far. So when you buy a new asset, you don't get to expense the entire portion of that initially, if it's a long-term depreciable asset, you only get to claim the depreciation for that period. And that comes from the asset's depreciation schedule. So again, this is related to the earlier point. We don't expense long-term assets based on the cash flows that occur related to those things. Rather, we depreciate them over time following a depreciation schedule defined by tax code. Finally, when we sell a capital asset or a long-term asset, what matters for the income statement is if there is a gain or loss that's triggered by that sale. So if you remember back to when we were looking at deferred tax calculations on the balance sheet, what we were concerned with is on the long-term asset side, what is the asset's current market value compared to its book value? In the event that you actually sell a long-term asset, those are the two things that will be compared. So what did you actually sell it for? That will be the market value for the asset at the time versus how much is that asset worth for tax purposes. What is its tax basis or book value? If the market value is greater than its book value, there is a gain that will be taxed. If you end up selling an asset for something less than its current book value, that would be a loss that would potentially generate a tax credit or reduce your tax bill for that reporting period. But again, it is only relevant when the asset is sold, and when that occurs, we compare the sale price or the market price, market value, to the asset's tax basis to determine if there was a gain or loss, and then the taxes or tax credit associated with that gain or loss.